Hey, good evening. This is Kim, and want to just provide you an update of the homework assignments and then next week's assignments that we will be doing and subsequently finishing for the rest of the semester. So here I'm directing you to the course homepage. We've already passed week 10, and you have already taken quiz 3. So thank you for that. Now we're in week 11, which started on November 28th. It's now November 30th, and I just put your homework assignment out there today for chapter 14. In addition, I'm going to go over the individual portfolio project, which is listed in your syllabus and going to be due by next Monday. So I want to go over that. I don't think it'll take you a lot of time, but I just want to make sure you're clear. And finally, next week, we're going to touch on Chapter 15, which is another derivative type investment called futures, and touch on real estate just a little bit more. And I will post your last quiz. Your last quiz is one case. It's a case where I will provide you with a couple, uh, a married husband and wife who are retired, and I will give you several bits of information, and you will have the opportunity to invest for them about $3 million. So you should be looking forward to that. And it's wide open what you do. I just want to see your thought process based on how I explain their risk profile to you. So moving on, I'm going to slip into the content area, and I'm going to direct you now to the first thing you'll see down here, which is your individual portfolio project. In here, you will see two files, a Word file, which is the narrative part of the assignment. I hope I've carefully outlined what you need to do. I'm going to go through it quickly. Way back when, in the first week of class, I asked you to develop a policy statement for yourself. And in that policy statement, I asked you about your current situation, goals, investment philosophy, etc. Now, I'd like you to go back and not only copy, but revisit those 5 sections of your policy statement and update them. And then you're going to tack on narrative in these following areas. We're going to talk about your asset allocation, how you want to divide your investments among stocks, bonds, cash, and then even with stocks, what type of stocks, bonds, what type of bonds, etc. So the chapter in the book, the chapter on portfolio analysis, really outlines what you need to do in each of these sections. So I'd like you to have your book open when you're going through this so you can understand what I'm asking for. Next, I want to talk to you about cash. Everybody needs to have some type of emergency fund or some short-term cash that's liquid. So I want to know from you where you would store that money, what type of an account. Very specific. Is it going to be a virtual bank? Is it going to be at your current bank? Are you going to do short-term bond funds? I want you to tell me. Okay, now moving on, we're going to talk about a stock analysis. In week 5, I believe, you selected 5 stocks that you wanted to study over the course of the semester. I want you to take those 5 stocks and use them in the analysis that you're going to do on the subsequent Excel worksheet. Finally, you're going to do a mutual fund analysis by selecting 3 mutual funds or exchange traded funds, either one of your choice. Now remember, when we evaluate mutual funds, we step out and move into Morningstar, so we don't do them at the Fund Family website. Instead, we're going to go to Morningstar and you're going to do all your research at that site. Last week you learned about the Sharpe, Trainer, and Jensen ratios. This week for your selected funds, you're going to go look these up and provide some interpretation of those that you would need to use if you're going to select funds for your portfolio. And then lastly, you're just going to talk about where you would broker your accounts. Are they in 401ks? If they're in IRAs, where do you hold the IRAs? Why would you go to that particular vendor for your account? So now I'm going to go back up here, and what I really want to explain to you is how this spreadsheet works. So I'm going to download this Excel document. And you'll notice at the bottom Okay, here we go. At the bottom, you have 3 tabs. You have investor profile, stock analysis, and mutual fund analysis. I'm going to start with the investor profile. It is here that you will enter everything in the gray boxes. So your overall portfolio objective, for example, my portfolio objective now is growth. I'm looking for not preservation of capital. I'm not looking for anything but really growth. I also don't need any current income. My specific financial goals. Now here is where I would put. I'm planning for retirement. That's my number one goal. I am going to pay for my kids' first 4 years of college or for their undergraduate degree. So that's a major goal of mine. I suppose those are my 2 primary financial goals at this point. My desired asset allocation. Again, I've already put the categories here for you, but I want you to put your percents by category, what fits with your risk tolerance level, and then you'll read about flexible or fixed weight in the book. And then lastly, what's your desired annual return? So here I might put my desired annual return is 8%. That's what I want, but I don't know what yours is. So after you fill this out, I want you to tell me. Now over here on the right in red, you'll see some more specific information. The pages to read to answer these questions. Again, I want to see at least 3 financial goals, and then the rest is pretty self-explanatory. So that's the first part of this project. Next, you're going to click on the second tab, which is your stock analysis. So what I've done for you here is I'm assuming that for your selected stocks that you're going to buy 100 shares of each. So over here, you're going to type in whatever the stock name is. You're going to overwrite Visa here unless Visa was one of your stocks. Well, let's say you picked Facebook. So you're going to put Facebook in here. You're going to go collect the opening price for January 4th. So we're going to pretend as if you've had these stocks for nearly a year by the time this is all said and done. So when you go here, you're going to, let's say for example, I'm going to show you, I'm going to go here to finance.yahoo. And I want to quickly remind you how to look up a historical price. So I'm going to look up here Facebook. Okay, once I'm in Facebook here, I'm going to go to historical data. And what I want to know, I'm looking for that price on January 4th at the beginning of the year. So my time period, I only really need 1 day. Okay, and the day that I want is 01, 04, 2016. 01, 04, 2016. So I'm going to click done right there. And that did not take, so I'm going to do it again. This is really slow. Sorry. There we go. That time it worked. Don't forget to click apply here. So on that day, the opening price, and I'm going to ask you to use the opening price, was $101.95. So I'm going to take that number and I'm going to go back over here. My opening price is $101.95. Okay, so that was my purchasing cost. The math formulas are already built in. Now you can just type in the current price. So if I go back here to to Yahoo, I see Facebook is now 118.42, and you can use whatever price shows up at the time you do that. So I'm going to put 118.42. That's my current price. That's my current market value. There's my unrealized gain because I haven't sold the stock, so it's unrealized. Next thing I want is the annual dividend. Again, I want you to find that just on the website. So if you go to whatever website you want to use, but you're going to go to the summary. And I know that Facebook doesn't pay a dividend. So in my case, for that particular stock, my annual dividend is 0. So I'm going to have 0 dividends received. So far I only have $1,647 of gain. So anyway, you're going to key in that annual dividend posted on the summary page and then let it calculate the dividends received, which it'll do by multiplying the annual dividend times the number of shares. Okay, so finally you're going to calculate your holding period return. And I did not put this formula in here because I'd really like you to use your own Excel skills and figure it out. And then lastly, how has the S&P 500 performed if that is your relevant index, which I'm assuming it is because most of them are large cap, but how has that performed over the same time period? So I'm going to look up the S&P 500 year to date and then really evaluate how your 5 portfolios would have performed just next to the index. I mean, you may find that the index outperformed your 5 stocks that you really wanted to follow, and oftentimes that is what happens. So anyway, but I want you to be able to calculate it so you can make informed decisions in the future about your stock holdings should you ever decide to hold individual stocks. So there you go. Once you finish all this, then you will again summarize your results back in the documentation that I asked you to do. So when you're done with stocks, then you're going to click over here into mutual fund analysis. And here again, this is just an example which you won't pick. VIG is one of my favorite Vanguard mutual funds because of its tolerance level in down markets. But aside from that, it's a no load fund and its expense ratio is 0.09. Again, I collected all this from Morningstar. The next thing I want you to do is look at the annual or the aggregate returns for 1 year, 3-year annual average, 5-year, 10-year, and since inception. And if one of these doesn't exist, no worries, just leave it blank. Finally, I want you to pick up the Sharpe, Trainer, and Jensen ratios for your shares. Actually, this should be colored also here and here. So just remember that. You want to pick all those up. And then get the relevant index. So you can't select the S&P index as one of your funds. I'd like you to select some other index. And then really we want to know these are all a measure of performance on a risk-adjusted basis. So for example, if your portfolio formed equal to the S&P 500 and yet it was 10 times more risky, then these are the ratios here that would indicate that risk level. And really, we don't want to expose ourselves to a lot more risk for the same amount of reward. So these become important in terms of our evaluations of our mutual fund holdings. Now again, if you had picked a bond mutual fund holding, when you go to Morningstar, so let me go here and tap into Morningstar for a second. When you go in here with whatever fund you pick, so VIG, so this is an ETF. So I'm going to click in here on ratings and risk. And then I'm going to go ahead and ask you to stay on the most recent 3-year statistics for risk. And this is where you're going to pick up the information. So for VIG, it has the index as the relative index as the S&P 500. But if I had a bond fund, so let's go pick a bond fund. Let me go Vanguard total bond. So now I'm going to pick BND, for example, a bond fund. And I'm still on ratings and risk. Okay, but it has a different index. So it used this Barclays US aggregate uh, index. And by the way, that symbol is AGG. So you, again, all of the evaluation for these ratios against bonds would have a different index to use. So I just want you to be aware of that. So anyway, you'll collect the alpha and uh, and the Sharpe ratio and the Trainer ratio. So there's all three of them. Doesn't exist, it doesn't exist. That's just the way it is. So anyway, that's what I want you to do and provide some analysis. And that will then wrap up your individual project. So again, you'll complete the tables and then go back and finish the narrative that I've asked you to answer. So if you have any questions, shoot me an email because if you have a question, I'm sure there's others who also have a question who need some clarification. So besides that, in the content area, you also have a homework assignment. So here it is. It's right down here, week 11 homework. This is where we start talking about derivative investments, options, and futures. And in addition to the assigned pages in the book, now I don't need you to read all sections of the book, just a few pages at the beginning. And I've asked you to watch a short video. And I just want you to have an overview of puts and calls. So I'm interested in that if someone asked you, hey, what's an option, that you would really be able to explain, hey, a put is an option to sell stocks and a call option is an option to buy stocks at a strike price. I want you to understand that level of language related to those investments. And then I've asked you some really simple problems. They're really you can probably answer these without even cracking the book. There is one problem down here. It's often what I might do for my clients is that I would use some put options to hedge against risk. And so I want you to think about that, how we can use options to hedge against the risk of a stock portfolio specifically. And I want you to go ahead and answer that. I was going to give you a case, but we're running towards the end of the semester and we didn't have a full 16 weeks since this was a late start class. So I'm pushing that off. If you want to know more information about puts and calls, again, just let me know. And we can have a one-on-one and talk about that for a long time. If not, then that's your assignment for week 14. I'm going to make them due next Monday. So that would be Monday the 5th. I'll put the dates on them right now in the Dropbox. And good luck and have a good rest of the week. Thanks.